What's up, everyone? My name's Robbie. This is Robbie in Manila, and today we're talking about the SPYD ETF. So I've been so impressed by seeing the returns of this ETF year to date so far that I thought it would be good to actually do a whole video on the ETF. Now, I did pick this ETF as my top mid-cap dividend-paying ETF one of my previous videos just recently, and what I want to do today was actually compare this to the other, let's say, counterparts. So SPY, right? So SPYD is the Spider Dividend Yielding ETF, SPYD. There's SPY, right? So that is the S&P 500 ETF, which you've probably heard of. It's one of the most popular in most assets under management S&P 500 ETFs. You also have SPYG, which is the growth portion of that. Then you have SPYV, so that's the value portion, right? So I wanted to compare these and kind of tell you why I think it's interesting to take a look at SPYD right now. So right now I'm looking at a chart going back 5 years, and what you're going to see is not anything very interesting about SPYD. So SPYD was the lowest performing out of all of these different ETFs at the time. So 55.92% return, which, okay, that's fine. It had an okay return. But SPY, the S&P 500, had a 82% return over that time period. And actually, if we kind of take out the recent time, it's been much better, 135%. And then, of course, when you look at SPYG, the growth portion of this of the S&P 500, it's done better, right? Because growth has outperformed value. It's outperformed dividend stocks, right? So growth has done a very great job over the past 5 years until the start of this year. So going back to look at this on 5 years. So again, I wanted to just show you that growth is definitely on the decline. The SPY is on the decline, but SPYD has not declined as much relatively, and so is SPYV. And now you'll see when we go closer in, so I'm going year to date since the start of the year, look how this changes. So now we have SPYD up 1.95%. The S&P 500 is down 16%. So this ETF is holding up very well in what is pretty much a bear market right now. There's a lot of talk about how there is a rotation out of growth into value, and that's true. And as you can see, SPYV, which is the value portion of this ETF, is down 7.68%. So it's better than 16%, of course, right? But it's not as good as this dividend yielding stocks inside the S&P 500. That's why I kind of wanted to discuss today a little bit of a deeper video going specifically into this, comparing it to these, and even talking about SCHD in here too. So let's figure out what's going on with SPYD. We got a lot to go over in this video. Hope you stick around. Let's get started. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. Okay, I did want to ask you a favor. So first off, of course, hit that like button, subscribe, do all that stuff. Please, thank you. And then also have some affiliate links below. If you're interested in Barron's newspaper, I have an affiliate link that will give you a deal to get a Barron's newspaper. That is like the best stock market newspaper there is, in my opinion. I don't get it over here, the physical version in the Philippines where I live. So, take advantage of it. If you live in the US, I'm jealous of you. You can get that newspaper using my affiliate link, so thank you if you use that. Now, what is the Spider ETFs basically? So what is Spider ETF? So when you look at these SPYD, SPYG, SPY, they're Spider ETFs, SPDR, right? So here I'm on the State Street Global Advisors website, Spider. So this is their website. And what I want you to understand is S&P, so the S&P 500 index, that is actually owned, so the company S&P Global, that's the actual company, which is this company here, S&P Dow Jones Indices, a division of S&P Global. Well, this is the index creating part of the company, and then Spider, SPDR, the State Street Global Advisors, is also part of S&P Global. So the company that made the index, the S&P 500 index, is the same company that is, well, it's a subsidiary, I think, of S&P Global, okay? Anyway, they're connected, just so you know, and I think it's interesting, and when you're learning about these things, it's good to understand the connection between all these different things. So right now we're going to hop in real quick to the methodology they use for SPYD, so the S&P 500 High Dividend Index. So SPYD uses the index or the benchmark, right? This is the benchmark it uses. The methodology to find the stocks that go into this ETF, it uses this methodology. Right here in the intro, we can see it says the index objective. So the S&P 500 High Dividend Index consists of 80 high dividend yielding companies within the S&P 500, and it's equally weighted. That's a very important point that we need to get across here. So when all these other ETFs, not all of them, but a lot of ETFs, they base the weighting of the stocks in the ETF based on how big the company is. So Google, Apple, Amazon, they're going to have higher weightings. The more portions of the ETFs are going to be in those bigger companies than smaller companies. This is not like that. This is equally weighted. So this is equally weighting the positions. So all the positions, no matter what stocks end up being selected to go into this ETF, they're all going to be similar weightings, similar size portions of the ETF. Now what this ETF does is it takes 80 of the highest dividend yielding stocks that are in the S&P 500, okay? So it takes those stocks, it just equally weights them, boom, done. It's actually a pretty easy methodology to figure out. So this one is a lot different than, let's say, VYM. And so what I want to show you here is that VYM, just for an example, SPYD here on the far left, having 80 positions, right, 80 stocks inside the ETF, versus VYM, 448 different stocks. So VYM, which is the Vanguard High Dividend Yield Index Fund ETF shares, has so many more stocks in it than this one. But what is interesting is the yield of SPYD. So if we take VYM versus SPYD, almost a full percent more in yield you're getting in SPYD than you are in VYM. So essentially what the deal is here is that you're getting some very good yield for this ETF, and it's been holding up well in a pretty bad bear market. Honestly, it's probably a bear market. If it's like actually definition-wise, it's not actually a bear market because it's not down 20% yet for the year. But I mean, it's essentially a bear market right now. Now, for all the SCHD fans out there, you might want to know what this looks like compared to that. So SCHD has a 30-day SEC yield of 3.21%. This has 3.27%. So this has a higher dividend yield than SCHD as well. SCHD having around 100 something positions in it. Let's take a look. Yeah, so 104 positions in SCHD. Again, SPYD a little more concentrated with 80. And of course, it's only the S&P 500 stocks that are allowed to get into this. And there's no other kind of like factor tests or anything like that. It's not using different ways to weight based on, let's say, ratios or like returns on equity or anything like that. And so to kind of show you where SPYD falls within a style box, just want to show you this real quick. I think it's important. So SPYD is this blue part. This dot here shows that SPYD is a pretty much, it's like a mid-large blend. You know, it calls it more of like maybe a mid-cap ETF. So mid-large blend. Now this thing's definitely tilted to value, right? So like we said before, value right now is probably going to be doing better than growth this year, at least I think. Looking at what some work done by Lizanne Saunders, who is a pretty awesome Twitter handle. So take a look at her if you like to look at this stuff on Twitter. So basically, year to date is the blue bars here. Month to date is the yellow. So Russell 1000 value. So let's say the large, maybe a bit of mid cap stocks. So let's say mid-large blend is negative 6.3%. And this is value, the value part of the Russell 1000. If we look at the Russell 1000 growth, down 21.5%, down 1.7% right now for the month to date. Also worse than what's going on in the Russell 1000 value for the month to date. So as you can see, large mid blend wise using the Russell 1000, it's definitely better right now. Like since the start of the year, it's been better to invest in value stocks than in growth stocks. And I actually think that's probably going to continue almost probably till the end of the year. I don't think growth stocks, the growth portion of the Russell 1000 is going to outperform the value portion of it this year. Another thing to kind of look at here is that the Russell 2000 growth, which is the small cap stocks, is actually doing worse than the mid-large blend. So maybe a bit better to have this mid-large blend than having mid-caps. So mid-caps, well, you could look at this two ways. You could say maybe this has further to go down, or you could say, well, these are just more volatile, so probably going to come down faster. Maybe they'll go up faster even. And so the last thing I want to do is just take a look at the portfolios and show you some of the differences. But SPYD having, we had 80 stocks in it. So SPYG, so the growth portion of the S&P 500, 241 stocks. SPYV, the value portion, 448 stocks. SPY, 507 stocks, so that's the S&P 500. And then SCHD, which I threw in here as 104 stocks. To see the top 10 holdings, you could see SPYD, like I mentioned before, it's an equally weighted ETF. So the positions are going to be all closer to each other. Unlike here, for example, you have Apple taking up 14% of SPYG, and SPY, you have Apple 6.98% of the entire ETF, right? So when you go down further, there's a lot less weightings in the smaller companies. That's not what goes on in SPYD, which I think might be an okay thing right now, considering what's going on in the market. Essentially, I think an equally weighted portfolio of S&P 500 companies that have good dividend yields might actually be a decent place to have a little bit of money. This is not thinking in terms of having huge growth or total return. This is you get some yield. It's a bit safer, I think, in my opinion, and you might not get as much upside, but you're going to get less downside. And so if you want a defensive portfolio positioning in an ETF, that might be something that works out, SPYD. Last thing to look at, sector weightings. So how are the sectors? So SPYD, again, it's more defensive. It's got 18% in utilities, the most out of all of these different ETFs, and utilities, which are more the defensive parts of the sectors in the market. And then if we take a look even further, we say consumer staples is the next one that's probably the most defensive, 11.4%. So one of the higher positionings in consumer staples as well. And then I like energy and I like financials, and it's got both of those. So it's ticking the boxes essentially of some of the things that I want to see in an ETF for sectors, for what type of style box it's falling under right now. So I think it's an interesting ETF, and it's got a great yield. So I just wanted to maybe make this video to get it out there. If you haven't looked at this ETF yet, maybe it's something to take a look at. I hope you liked this video. That's all I have for this one. If you did, please hit the like button, subscribe to see future content like this, and watch another of my videos coming up on the end screen right now.